Today, I'm going to take you through the one strategy that could derail your investment plans to build a portfolio in the future that the banks won't tell you. In fact, this could reduce the amount of equity you've got available for your next property by 50 grand. So why don't we dive right in? So today we're going to talk about cross-collateralization, otherwise known as cross-securitization. There's a number of different terms for it. Effectively, it's where the bank secures both properties by both loans or all your lending that you've got. This can have multiple implications on your ability to borrow and build an investment portfolio in the future. And today we're going to go through some things around this to ensure that you don't make the common mistakes that we've seen time and time again with investors looking to grow. So just before we get started today, this is an advanced strategy. What we're talking about is more for investors wanting to grow their portfolio above 2 properties. So today is more specified to those out there that want to grow. So what is cross-collateralization? So cross-collateralization is where the bank secures one or more loans against 2 or more properties. So we're going to walk through an example now of what cross-collateralization looks like. In this example here, we've got someone that owns property A and they're looking to buy property B. What cross-collateralization looks like is where the bank will take both properties and secure it against both loans. Where we've got in this example here, where we've now got property B and then we've got the new loan which has been secured by both properties. So many investors have their lending cross-collateralized and they don't even know about it. One way to find out is to call your bank or even check your loan contract where you can find out whether both properties are securing both loans. Now the reality is many banks will look to set up your lending if you're buying your second property in this fashion. Now there are a number of downsides which we're going to go through in a minute. Be aware of it, it's definitely something you want to try and avoid. So some drawbacks of setting up a cross-securitized structure is, number one, you're going to have limitations in the amount of equity you can pull from the property. So in this example where we've got both properties secured by both loans, if one property skyrockets in value, the other property goes down, well, you're getting the average of the two in equity. So you're always going to not be able to pull out the maximum equity from property A because everything's been averaged out. So the second drawback is increased complexity. What I mean by that is if you're looking to get your third property and you're adding it to your portfolio, each time you look to leverage equity, the banks are valuing the 2 existing properties and then you've got property C coming into the mix. It just adds another layer of complexity to your portfolio. This will continue to get more complex as you keep growing. And as well as that, remembering you keep averaging out the equity across the property. So if one property is increasing in value, one's gone down because it's in a different market, you're always going to get the average equity released. So the third drawback of cross-collateralization is that it limits the options you've got available from the lenders, meaning that when you're structured cross-collateralized, you can only really deal with the one lender because all the properties are entwined with each other. So what that means is as you continue to grow, you're going to be restricted by the lender's policies and credit criteria, and that means you can't cherry pick once again between one lender over another because they have a better borrowing assessment, a better credit criteria, or a number of different reasons that they might be more suitable for you. So when you have this structure, you're always limited with dealing with the one lender. It's a better strategy to leverage multiple different lenders to maximize your abilities to borrow and leverage across the board. So you're probably asking yourself, how can I avoid cross-collateralization with my lending, particularly if I want to build an investment portfolio? Well, it is quite simple. It's setting up each loan so it's standalone against each other. So in this example, you own property A, it's worth 500,000 and you only owe 100,000. You're looking to buy another property which is going to be used as an investment. Now, how can you set this up so that the properties aren't cross-collateralized? Well, firstly, we'll set up a new loan on the new purchase. So let's say you're going to buy for 500,000, you're going to buy property B for 500,000, we'll lend 400,000 on that, which is 80%, and then we'd release the equity against this property for the remainder, which will be 100 plus your stamp duty and other government costs. What this means is that you've got effectively another loan set up against your existing property A, and you've got a new loan against the new property B. This allows you to set up the loan so they're all standalone. This could be with bank A or bank B, They don't have to be with the same lender. As you continue to build your portfolio, you can continue to leverage equity where equity lies across the portfolio and cherry pick the property in which has the most equity. So I'm going to run through a real example of a customer I've recently assisted. Joey and his family owned 2 properties and they had the bank set up their lending so it was cross-collateralized. So I've got the example here. They owned a property in Narangba worth $500,000 and they previously bought a property in the Sunshine Coast. It was worth $400,000. It's gone down. It was now worth $300,000. It was a small unit and it had gone down in value. What this meant for him with this structure that the bank set up for him was both properties were secured against each other. So there was a loan of $300,000 and a loan of $210,000, which was cross-collateralized over both Narangba and Sunshine Coast. When we went to revalue the properties, they did come in at $500,000 and $300,000, so the Sunshine Coast had gone down dramatically. What this meant for them was they only had $130,000 in equity, which we could leverage, which meant that if they wanted to buy right up to $1 million, they were going to have lender's mortgage insurance either on these properties or the next property. So the equity available was limited and meant that they needed to come up with more cash to avoid things such as mortgage insurance. Now, how could a separate structure as a standalone structure have benefited Joey and his family? Well, I've got an example here of what it would have looked like. Effectively, in this same example, when he set up the lending, the $300,000 would have been on the $400,000 property, which is now devalued and now worth $300,000. So it's at 100% lend. But once it's set up as standalone, the banks will leave it. It's a 30-year term. As long as they're meeting their repayments, it's all good. On their property in Narangba, still worth $500,000 with a 210 loan, it meant that they had $190,000 in equity. So it meant that they could leverage far more equity than the original example that we talked about here. So this is where the benefits of a standalone structure work. With that 190 on $1 million purchase, that's close to your 20%, the 10,000 off, plus they need stamp duty. So it's a little bit better proposition for them and gives them a bit more leverage with this sort of a setup. So this is the example, remembering, aim to keep everything standalone and you'll be able to keep growing as your properties potentially value higher or lower. You can cherry pick where the equity is coming from. So that's it for today, guys. Remembering your bank is automatically going to set up your structure so you cross-collateralize. Remember to ask your mortgage broker to ensure that you set up your lending all standalone so that you can continue to grow in the future. Feel free to leave some comments below, like and subscribe, and if you have any questions, feel free to hit us up at huntergalloway.com.au. Thanks for watching.